Welcome to Illuminati's Silver. We tell you the truth about silver. Today is Friday the 30th of September 2016, and we're providing our views on the future direction of gold prices for the remainder of the year. In part 1, we covered those influencing factors such as fear of a global crisis, inflation and currency devaluation, value of the dollar, interest rates and negative interest rates, central bank instability, government reserves, jewellery and industry. In this part, we're going to provide our forecast price predictions based on those factors, plus a few others. Before we do that, it's worth quoting Mark Bristow, South African-born founder and chief executive of Rand Gold Resources, as he foresees a looming supply problem in the gold industry, saying that there was not enough exploration to replace gold that was being produced. Quote, "To keep the gold industry supplied, we need to discover 90 million ounces a year. We are only discovering 10 to 15 million ounces a year. We either have to discover more quality ounces or reduce the life of the mines." According to the World Gold Council, total supply increased by 10% year on year in quarter 2 to 1,144 tonnes versus 1,041 in quarter 2 of 2015. First half supply is just 1% higher year on year, the slowest rate of first half growth for 8 years. The main contributors to this growth have been recycling and hedging, both of which have been supported by higher gold prices. So providing demand for gold continues or strengthens, then potential supply shortages will undoubtedly have a positive effect on gold. So let's look again at demand as quoted by the World Gold Council. Quote, "Continued growth in quarter 2 of 2016, up 15%, brought total half one gold, or the first half gold demand, to 2,335 tonnes, the second highest first half on record. Huge ETF inflows during the first 6 months, which was plus 579 tonnes, were counterbalanced by anemic jewellery demand in an environment of sharply rising prices. In fact, the gold price posted the strongest first half performance, up 25%, for more than 35 years. Record first half investment demand of 1,063 tonnes was 16% higher than the previous first half high from 2009. Investment was the largest component of gold demand for 2 consecutive quarters, quarter 1 and quarter 2. The first time this has ever happened. So, we can see that the main driver for gold is currently investment demand, as we mentioned in part 1. But can this continue? Well, according to Henry II, a contributor to Forbes.com, a site we know many of our subscribers are critical of, being perhaps beholden to the establishment, he thinks gold is now in a new bull market, as indicated in his article dated the 1st of July 2016. He gives 3 main reasons for this. 1. Global gold mining production has plateaued despite the recent bounce in gold prices. 2. Both the global monetary and fiscal policy outlooks remain highly expansionary. And 3. Chinese and Indian demand for gold will continue to rise. His recommendation at the conclusion of this article, quote, "I thus believe gold remains a solid long-term investment and the time to buy gold is now. I anticipate a gold price of $2,000 an ounce by 2020. Unquote. Now we all know that this price point of $2,000 may disappoint many listeners and subscribers to our channel. After all, we're constantly being fed by the pumpers that gold is going to $10,000 anytime soon. So $2,000 in 3 years seems paltry in comparison. As gold continues to rally in 2016, one of Wall Street's most closely followed commodity watchers says we could be in the early days of a historic rally for the precious metal. Best-selling author and economist Jim Rickards explained that, given the consistency of a financial panic every 10 years, investors should brace for another disaster in 2018. Yet this time around, Rickards believed that it's the US government itself that may trigger the next crisis. However, the catalyst for gold's gains could stem from a nerve-wracking sequence of events. Quote, "We should expect the next global financial panic soon," said Jim Rickards on CNBC's Futures Now on the 12th of June 2016. "We have imploded twice in the last 16 years, so get ready for the third one." Unquote. His latest book, The New Case for Gold, defends the rationale that gold always has been and always will be a true safe haven during volatile times. He therefore urges investors to think of the commodity as insurance, not as an investment. Quote, "In 2018, who's going to bail out the central banks?" Unquote, asked Richards. "The bailout money is going to come from the IMF, as they have the only clean balance sheet left," he adds. This occurrence, Rickards believes, will drive gold higher to $10,000 to be exact. That eye-popping sum is not a made-up number, Rickards insisted. It is the implied non-deflationary price, he reasoned. He does admit, however, that the economy will have to implode for this to happen, but pointed out that this has happened twice in the last 16 years, and the only people who can bail out the Fed and central banks is the IMF. But what if the economy does not implode? Not all economists agree that it's a certainty, and this is a factor we're going to raise in a future video. However, what about 2016, we hear you ask? Well, for us, there are 3 potential significant impacts. 1, China's currency becoming part of the SDR, which will have a small possible uplift for gold prices short term, but no dramatic move for 2016. 2, the Fed and interest rates. Well, we believe the Fed will raise rates once by either 0.125% or 0.25%, again to save face by December. This will probably have no impact on prices, unless, of course, they state that the economy is so robust that more will follow shortly, which is unlikely. If it does not raise rates at all, we can probably add $50 to current prices. And 3, the presidential election. If Trump wins, we believe gold will almost immediately rise by $100 to $200 an ounce because of uncertainty. If he loses, it will maintain the then current level. So fully acknowledging that supply is tight and investor demand is high, and that Trump does not win the election, and the Fed does raise rates, we see gold ending the year around the $1,400 mark. If Trump does win and the Fed does not raise rates, then we can see gold edge towards the 1,550 level. Either way, we see it higher than it is today, standing at $1,321. At the start of this video, we mentioned that Mark Bristow of Rand Gold pointed out supply issues. He also added this comment, quote, The only way that the industry will deliver what it has delivered in the past 8 months is to have another increase in the gold price. But it will be impossible for the gold price to go up as it did over the past 8 months, end quote. Thereby saying that it is impossible for gold to rise another 25% or so from current levels this year. If that were to happen, gold would stand at $1,650, and like him, we do not see that figure being reached in 2016. Of course, if there is an economic implosion, then all bets are off. Even without it, though, we are bullish gold at current levels. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Our Facebook page, which is updated daily, can be found at facebook.com/illuminatisilver. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.